Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail annuity basics and really dissect the pros and cons of annuities. I want to show what a typical situation is regarding retirement or accumulation or safe growth plays, and then show you the different annuity contracts out there and expose a lot of the BS out there regarding annuities. A lot of the, okay, this is the greatest thing since sliced bread. You know, what does an income rider mean? What is a fixed annuity versus a fixed index annuity? What is a variable annuity? Why do I not like variable annuities? All those different things I want to try to outline in this video. So this video is definitely going to be lengthy, but I feel it to be very necessary for you guys to become highly educated on an annuity and see. I'm going to show you examples where individuals fall victim to an annuity trap versus examples when an annuity is correct for that individual situation, or when we might make a recommendation for an annuity contract. So I would recommend to take down pen, paper, pencil, and take down some notes. And even if it takes you a few days to kind of review this video and you're breaking down each section, I think that that's going to allow you guys to be more fully acclimated. Also, at any point in time that you have specific questions or you're interested in a specific annuity contract or an annuity process, feel free to give our 1-800 number a call at any time, 24 hours a day, 7 days a week. And then at the end of this video, I'm going to show you our website where you could set up an appointment, a more concrete appointment specific with that specialist, one in particular that would be pertaining to this video on the annuity basics. So let's get started. A typical situation for retirement is an individual is working for a company and they're offered an employer-sponsored retirement plan, typically known as a 401k. You have things known as 401ks, 403bs, their savings plans, 457 plans, depending upon what sort of entity you work for. If you work for the state, you work for a nonprofit organization, if you work for a private company, all those different things are going to have different criteria, different qualification on how that retirement account is covered. But the overall concept behind it is an individual is working for a company. Let's say they start working in their 20s, and with the hopes that if they keep working, obviously they're going to be receiving income from that entity. It's going to be paying them money. So as they're working, they're obviously leveraging those incomes throughout their lifetime to pay for their expenses. And with these employer-sponsored retirement accounts, they're able to take a portion of their salary, a portion of their paycheck, and place that into a type of retirement bucket. So different things that grow this 401k or employer-sponsored retirement plan is the combination between the contributions that are going into this plan and the rate of return. So if the contributions, if you're not adding any dollars into your employer-sponsored retirement plans, well, obviously there's not going to be anything in that bucket. If you're adding a bunch of dollars in there, but then you choose the wrong options, the wrong funding options, and you're super risky in your investment strategy, and the stock market goes down, well, then you could have large losses. So it has to be the combination of contributions and rate of return. If you have a fixed rate of return and you have fixed contributions, well, then that should increase your bucket on a fixed basis. If you have variable or flexible contributions and your rate of return is up, down, all over the place, well, then you could have a positive bucket, a larger bucket at the end of the day, end of the year, or a smaller bucket at the end of the day, end of the year. So it's that formula is really just as simple as that. What exactly is the concept, and why do individuals try to invest their dollars for retirement? Well, obviously to pull from that bucket later on. So if they're working and they're contributing to that bucket, they want that bucket to grow as large as possible so that right when they hit retirement age, let's say age 65, they could now start taking distributions out of this bucket and use this bucket, all that money that they've accumulated, for retirement income later on. So sometimes individuals are offered not just a 401k related plan, as they might be offered a pension plan, which says that the employer is going to essentially take care of your retirement for you and define what your benefit's going to be. So if you gave X amount of years of service, this employer is going to say, okay, well, you're going to get $4,000 per month right when you hit your deemed retirement age. So at that point in time, an individual that has a defined benefit pension plan can have the combination of the income that they're getting from their plan, from their employer during their retirement years, and then obviously Social Security, if they place into the Social Security system, That would be another income source coming to them. So it would be the combination of these two main income sources that could hopefully be larger than what their expenses are in retirement. So obviously when somebody's working, they have to work more hours if they have an increase in expenses to suffice what those expenses are. If somebody's in retirement, well, they have to have more money, or at least have a strategy that allows them to receive more dollars that will correlate to whatever those expenses are. So it's just as simple of that concept. Well, unfortunately, with typical plans and typical individuals, they fall victim time and time again to something known as reverse dollar cost averaging. And what reverse dollar cost averaging says is it's a combination of negative aspects that liquidate that sort of retirement account as quick as possible. So just as a quick example, if somebody goes and they have their money invested in a 401k and also they retire and they roll their money into an IRA and they're having a financial advisor that's monitoring that account, well, there might be some fees that's associated with that IRA. If this advisor put them in mutual funds, you're going to have mutual fund related fees. On top of it, for that advisor's expertise, they're going to try to charge you an advisor fee. This account, because if it's tied to investments, like we understood with the 401k, if you're not in a fixed account and you're tying it to the market, well, that means that you could have a positive. Your account could go up one day, 1 year, or it could go down. So an example when it went up was in 1980 through 2000. You had over 1,100% gain into the markets. Everybody was making money hand over fist. Well, then you have 2001 and you have 2008 where you had average portfolios that lost -30 to -60% in just that 1 year alone. So this rate of return, it's not as simple as just saying, okay, I'm just going to, throw my money with an advisor and then he's just smart enough, he's going to be able to figure it out. You have to make sure that you're understanding the pros and cons of a situation so you do not fall victim to that negative. And that negative, that very large negative, is downward market loss potential. When the account does go down, if you're invested primarily in investments, well, there's some level of risk there. If that account goes down, well, how much downward market loss are you going to be receiving? The fourth aspect is income. If you're in retirement and now you have to try to pull income from these accounts, there's different rules out there. Like you have something known as a 4% rule or prudent man's rule, different things that try to help calculate. But at the end of the day, if the market keeps going down and going down and going down, that could be a very large problem for retirement accounts. And then we could also incorporate inflation, basically inflationary risk, meaning purchasing power risk, which just basically says cost of goods and services are going to be increasing. As they increase, then your expenses should be increasing with that pace of inflation. So therefore, it's going to force you to pull out more money from that account each and every year. So a really quick example of reverse dollar cost averaging and that negative aspect would be if you had an IRA account that has $1 million, and let's say that they were being charged $10,000 of mutual fund related fees per year, they were being charged another $10,000 of advisor fees per year. They got hit with a 10% loss from this account, which is a $100,000 loss. They decided to pull out 5% of income that year, or $50,000. And we're not even going to incorporate the inflation loss in there. So out of this really quick example, they would have pulled out $50,000. They would have walked into the next year with $830,000 in their retirement portfolio. So now when you're trying to increase that rate of return, well, you're pulling out more income. It's a higher percentage than obviously that $1 million. If you get hit with another downward market loss, that's obviously impactful. You still have fees and you still have that advisor fee, so you still have this uphill battle struggle going. If you get hit with that sort of situation, this is just a 10% loss, which is a very realistic example. When you take 2008 and you had 44% losses, you had 25% losses, 57% losses, that's a lifestyle change. Even something as small as a 10% loss could be a large lifestyle change. You would have taken $50,000, you would have lost $170,000 worth of your portfolio value. When you do that a couple of times, that results in retirement disaster. And at the end of the day, what does that mean? It means you have no more money left. You have no more money to pull. You've invested those monies wisely. You've created a proper wealth accumulation strategy because you're still working, still able to pump those dollars in there. When it comes to the other side of the coin, when it comes to that retirement age, well, now there has to be a preservation and distribution strategy in place. Should you be leveraging annuities for that? Maybe, maybe not. It really just depends upon, which annuity might work for your situation, and then how your situation pertains. What is your exact goals, whether you even need to place dollars into an annuity. And some annuities, majority of annuities out there are actually complete shit. It's which ones are pretty decent for an individual state, for an individual situation. And that's what I want to hone in on, going through all the annuity basics. So what is an annuity? And I'm going to talk about it in its most simplistic terms and then explain to you the different forms of annuities that came out and what you probably see today. So you're able to say, yes, I saw bad things about annuities, I saw good things about annuities, so everything's justified. I'm going to try to leave everything up on the table. An annuity is the opposite of life insurance. So with life insurance, an individual is purchasing life insurance through an insurance company. And what it's doing is that it's protecting them from dying too soon. It's protecting their family members from dying too soon. So an individual would go and most likely make monthly, semi-annual, annual premium payments to an insurance company, and that insurance company is going to offer a large lump sum benefit. God forbid if this person passed away, if they had like a 20-year term in this person, 20-year term life insurance policy, and they passed away in year 15, well, then this lump sum is going to get paid to the beneficiaries. If, let's say they had a permanent policy, it was going to last them for the rest of their life, and they passed away, whenever they do pass away, that lump sum is going to get paid out to the beneficiaries. So annuities are the complete opposite of that. What's happening is an individual, we're still leveraging insurance companies. Insurance companies are the only ones that could use annuity contracts. But rather than systematic payments get paid to the insurance company, that individual is paying a lump sum to the insurance company, and the insurance company is providing them income in the form of monthly, semi-annual, annual payments to prevent them from living too long, not outliving their retirement dollars. So a really quick example would be, let's say if somebody accumulated their monies as they were working, they hit age 65, and they have $100,000 of cash, and they say, I need to pull out $10,000 a year of income. Well, if they do that and it's sitting in a cash account, meaning there's no rate of return associated with that bucket, this individual is going to outlive this money by what? 10 years. They're 5 years old. By the time age 75 rolls around, they're not going to have any more dollars in that bucket. What an annuity could do is this individual could take, or the concept of annuity is say, okay, what they could do is place the $100,000 with an annuity, trigger lifetime income, and now that $10,000 is going to, and this is just a hypothetical example. Understand that this is not going off of any current percentages or anything like that. I'm just trying to show you the concept behind it. They would be able to take this $100,000, surrender it to the insurance company, and then have the insurance company pay that individual $10,000 to the day they pass away. So if this person lives till age 95, well, he would have had that break-even point. He or she would have had that break-even point at age 75, and then they would have made an additional $200,000 of pure profit of dipping into the insurance company's pockets, of saying that gamble was worth it. We surrendered rights of $100,000 in today's money to receive $10,000 per year till the day we pass away, which was age 95. So basically the insurance company lost in that aspect, and that individual won. And that concept that I just spoke about is something known as annuitization. The individual is annuitizing their money. So when they go and they take their lump sum dollar amount and they give it to the insurance company, they just now surrendered all control to that money, of that money to the insurance company, and the insurance company is now paying them a set income stream forever that person could never outlive. So if somebody has longevity on their side, or they just want to have that peace of mind that they're receiving, whatever that expense goal is, they could go and we could calculate how much dollars to place into that annuity contract to therefore provide annuitization. Now, when I'm talking about the concept of, if you hit that break-even point, well, the individual wins and they're pulling from the insurance company's pockets. If, let's say in that situation, that person passed away, he triggered his income at age 65, and passed away at age 67, well, this person would have received $10,000, and then they would have passed away. The insurance company would have made an $80,000 profit. So therefore, the insurance company would have won on that side. That annuitization is exactly what drove people insane, or what made people really mad regarding that basic annuitization provision, is because insurance companies have all the actuarial data. They know to the decimal point what's the likelihood of somebody that's age 65 getting set into their contracts, how long that person's going to live till, or if they have a 60-year-old getting set up into that contract, male, female, how long that person's going to live. So they're utilizing the actuarial data. They're using the law of large numbers, meaning millions of individuals that are placing dollars into that company, invested on the back end, and therefore being able to suffice what those payouts are and still be profitable in the in the long term. So that first type of annuity I just explained to you, the basic type of annuity, was known as an immediate annuity. The way that works is an individual is paying that lump sum dollar amount to the insurance company, and that insurance company is paying out income immediately to that individual. The good thing is obviously they're receiving income for the rest of that person's life. The person's receiving income for the rest of his or her life. The bad thing is they cannot dip into that account if they ever came into like emergency funds, that they need to access those monies, or they had some sort of debilitating ailment that they needed to pay for that additional cost. And ultimately, when you're utilizing annuitization, you're versing an insurance company with hundreds of years worth of data and actuarial data that shows, okay, you're just guessing, you're hoping that you're going to live that long, and they know exactly statistically how long you should be living, and therefore that's why the insurance company wins almost every time with annuitization. That's an immediate annuity. The same concept of an immediate annuity, but on a deferred period, is something known as a deferred income annuity. So let's say if an immediate annuity, where you're receiving income immediately, this person's surrendering their money, they're receiving it immediately. Let's say this individual is age 65, and the immediate annuity is paying this person $5,000 of income per year. With a deferred income annuity, you could have that same 65-year-old individual, but instead of triggering income immediately, maybe they're going to defer it at age 6 till say age 68. So because they're surrendering their dollars today, they're deferring that growth. That larger risk is therefore going to come with a larger income. So the DIAs, deferred income annuities, are just like immediate annuities regarding annuitization, except for instead of that individual only receiving $5,000, maybe they're going to receive $8,000 for waiting those extra 3 years. But you're still in that same boat. You lost all control of your money, and therefore you're hoping that you're going to live long enough to dip into the insurance company's pockets, to get into the insurance company's pocket. You're betting that you're going to be winning. And this is why individuals have been frustrated with annuities in the past, is because, and a lot of individuals think that all annuities only have those traditional provisions, only have annuitization. And it's not the case, because now you have a whole slew of annuity contracts that came about since that point in time. There were changes that were created so that insurance companies could go and optimize these types of contracts, maybe not for the income, the person that just wants income, but somebody that just wants growth. So now they wanted to start competing with treasury bonds and bank related products, different things to say, hey, we have very safe contracts. We have a legal reserve structure making sure that if a company goes under, there's different tiers of safety that could step in to say that your money's safe over here. And how can we, with this really good safety, still provide a higher rate of return and incentivize individuals to go with our annuity contract over others. So now I'm shifting the conversation from an income only need to a growth need, something that will give that person more consistent growth. So the first newer type of annuity is known as a fixed annuity. And what this did was try to compete with the market share of bank CDs. So in the 1980s, 1990s, interest rates used to be at all-time, double-digit figures, all-time highs. So what an individual was able to do if they had a retirement need is they could go and, let's say if a bank CD, the way a bank CD works is that you're giving X amount of thousands of dollars to a bank. That bank is for a certain time commitment, let's say a 5-year bank CD. And then that bank, the entity, is going to be paying you a fixed interest rate in return. So if somebody put their dollars in a bank CD, and let's say this bank was paying with the certificate of deposit, was paying a 5% rate of return per year, that tells us that after the first year, second year, third year, fourth year, fifth year, this individual was going to be receiving $5,000 in interest, $5,000 in interest, $5,000 in interest, et cetera, et cetera. So after those 5 years, that individual would have been able to receive $25,000 of interest and walk away with their $100,000 after that 5 year was met. So when you had interest rates that were paying double-digit figures, an individual could essentially leverage $1 million, place it with a bank CD that's paying 10%, or multiple bank CDs that are paying 10% for 5 years, receive $100,000 worth of interest for each of those 5 years. After the 5th year, they have $1 million left over, and then they'll just go and reinvest it into a new 5-year contract. Fixed annuities, they wanted to be more competitive with this space. They understand that they have a legal reserve structure, just like banks have a legal reserve structure, a little bit slightly different, but just basically saying that both of these entities are very safe and their contracts are very safe. And so at that time when the fixed annuity, let's say if a fixed annuity is paying 5%, sorry, if a bank CD is paying 5% for a 5-year commitment, a 5-year fixed annuity might be paying 8%. If a bank CD is paying 10%, during that time, a 5-year fixed annuity might be paying 13%. So it's going to be right around 2 to 3% higher than what those certificates of deposit are paying. The bank CD has to be offered through a bank. The fixed annuity has to be offered through an insurance company. But you could utilize that same sort of concept. So, if this is paying $1 million and is paying 13% each and every year, well, that says $130,000 would get paid out each year for interest. At the end of those 5 years, then you'd have the $1 million remaining, and therefore that individual could then just reinvest in a new 5-year fixed annuity or 5-year bank CD, whatever that case may be. So it's just, the incentive is to go with a higher rate of return with a very safe related contract. So that's where a lot of fixed annuities took care of a market share, or took a lot of market share, during the 1980s, during the 1990s, early 2000s. You had interest rates that were still paying very high rates of return. So if you think about the concept of somebody investing their money, and let's say they got set up in a 401k account in 1980, they rode that market growth in year 2000, and then they say, okay, I noticed that 2001 the market starts becoming more volatile. I want to have safety on my money. I'm going to take my $1 million and I'm going to go invest it into a fixed annuity that's a 5-year fixed annuity that's paying me 8%. So therefore they could receive $80,000 of interest per year. And after the 5 years, take the $1 million and just reinvest it and reinvest and reinvest it. So they don't have a risk associated there because they're in a very safe contract, a legal reserve structured contract. That individual has the peace of mind that their money's safe and that rate of return that they're receiving, the fixed rate of return, is going to be safe as well. Well, unfortunately, there was a dramatic shift that took place. So rather than interest rates at all-time highs, you started seeing them drop and drop and drop. So rather than like a bank CD that was paying 8%, now you'd be lucky that if bank CDs are paying anywhere between 1 to 2% in a 5-year. Fixed annuities, you'd be lucky if you could see them paying 3 to 4% for a 5-year. So everything has shifted. You can't just rely on the market. That 1980 through 2000 growth doesn't exist anymore. There's reasons why that occurred. And then when you try to rely on interest rate environment, on that safe interest rate environment, that unfortunately has really gone by the wayside. So that's obviously the problem with fixed annuities right now, or just fixed accounts in general, is because it's paying such a measly rate of return. Some individuals still like fixed annuities because it's paying higher than bank CDs, but understand that they're essentially susceptible to what the interest rate environment is currently in. So they might be able to lock their percentage rate, like a 3% rate of return or a 4% rate of return, get that locked in there for 5 years, and then after 5 years, take their principal and try to reinvest it into something better. Or they could say they're going to take their portion and invest it into the market. So this is where fixed index annuities came about in the 1990s, and this is when they started being more and more attractive, especially in today's times. And when I'm talking about this section of a fixed index annuity, I'm not talking about a hybrid annuity, so I'm going to get to that. It's a hybrid annuity is just a fixed index annuity with an income rider. But if we're looking at our most basic components of a fixed index annuity, I want you to realize the concept of a fixed annuity, receiving a fixed interest rate of return, and then how exactly does a fixed index annuity come into play. So just like if you think of a fixed annuity like a bucket with a lid over it, and let's say that fixed annuity is paying 3%, each year it's as if the company is opening up the lid of that bucket and pouring another 3%. The next year, another 3%. Next year, another 3%. If the market goes up, that fixed annuity is paying 3%. If the market goes down, that fixed annuity is paying 3%. There's no change. Everything's fixed. A fixed index annuity states that rather than pay, in this case like 3%, that goes directly into the bucket, the concept behind it is they want you to receive, worst case scenario, 0% rate of return, or receive what the stock market index, hence the word I, or the letter I, word index comes into play. Whatever that stock market index returns below or up to that specific cap limit, or participation rate, or up to a certain spread minus whatever the spread is. So there's a couple different ways on the combinations on it. But understand, just like a bucket with the lid over it, a fixed index annuity has a bucket of a lid over it as well. Let's say that this fixed index annuity is tied to, in one of the indexing strategies, an S&P 500 with a 10% cap. What exactly does this mean if we're looking at a 5-year versus 5-year comparison? With the fixed annuity, we understand that 3%, 3%, 3%, for those 5 years, 15% is essentially being accumulated in that bucket on a fixed percentage rate. Let's say if we utilize this fixed index annuity with a cap of 10%, we obviously know the floor is 0%. Let's say the S&P 500 gains 20% the first year, loses 40% the second year, gains 7% the third year, loses 20% the fourth year, and let's just say gains 11% the fifth year. How exactly does the credit work on a fixed index annuity with these parameters? Well, it says year one, the S&P 500 had a gain of 20%. We're going to credit up to the cap of 10%. So therefore, the company is opening up the lid, pouring the gain inside, and now that 10% is completely closed and cannot go down. The next year, year two, the market, the S&P 500, lost 40%. So therefore, it's going to gain 0. That lid's going to remain closed. They can't pull anything out. There's no advisor fees. There's no mutual fund related fees, nothing like that. This is the basic components of a fixed index annuity. Year 3, market gained 7%. Our cap was 10%. It's going to gain plus 7%. Opening up the lid, pouring the gain inside. So now you have an even larger bucket than you did with the plus 10% in there. The next year, year 4, market lost 20. Plus 0% because it can never fall below the floor, and therefore that lid remains closed. And then the fifth year, the market gained 11%. Our cap is 10. So the fifth year, you had a plus 11% gain. Open up the lid, pour the gain inside. So now we understand on this side, because you didn't want to risk receiving a 0% rate of return, this individual received a plus 15% at the end of those 5 years. Each year you're receiving the credits. Understand that. On both of these contracts, you're receiving the credits each year. It's not like you have to wait those 5 years to therefore receive the credits. Each year is going to increase it. So like as an example, in the fixed index annuity, if you had $100,000 and it gained 10%, your account value at the end of that first year is going to be $110,000. If you're adding 7%, it's 7% of $110,000. Therefore, it's going to increase that further and further. So with this calculation, we understand that this was a plus 28%. It made more mathematical sense to go into this fixed index annuity, which beat out that pace of inflation, beat out that low interest rate environment, to make sure that it was more favorable for that individual situation. The safety of a fixed index annuity is going to be the same as a fixed annuity. They have the same legal reserve structure in place. Now, where individuals think that fixed index annuities are the best thing ever, is they're saying, oh, well, I'm just always going to have these phenomenal rates of return. There's a difference between risk and reward. If you're looking at an investment, you could have unlimited upside potential, but you could also look at unlimited downside potential. When you're utilizing these fixed index annuities, you understand you might be capped at what your upside potential is, but then you're also going to have a floor on that downside potential. So it's going to give you more of that consistency. Depend upon the indexing strategy. So like a lot of people think, oh, they just have to go into one product. There's over 1,200 combinations of fixed index annuities. So whenever somebody calls into the agency and they say, okay, I like the concept of a fixed index annuity, this is my situation, we're going to cherry pick the top 5 currently with that individual state, with that person's age, to make sure and say, hey, listen, you know, company A is going to give us 6 different indexes to choose. Company B is going to give us 12 different indexes to choose. You might have a combination of S&P 500. You might have a Deutsche Bank allocator index. You might have a Barclays U.S. Dynamic Balance Index. You might have a Morgan Stanley Dynamic Allocation Index, a Dow Jones Industrial, a Russell 2000, all these different indexes. So obviously the more plentiful the indexes are, but most importantly, the higher the cap rates, that's what distinguishes whether you have a crappy fixed index annuity contract or a good one. How much you could pull out of that FIA contract also determines it. So it's not just, okay, you know, I saw this good advertisement online or you know, this television commercial, and therefore that company sounded credible, I'm just going to go with that one. That's just like the other situation. You're shooting from the hip. You're not actually taking a measured approach, and that's where it could really bite you in the butt. So unfortunately, with annuity contracts, over 90% of them are complete dog shit, or more for the benefit of the insurance company rather than for the individual. So what we pride ourselves on is trying to cherry pick and find that diamond in the rough and saying, this is going to be, or these top 3 or top 5 options are going to be the best options. This is what we would recommend. We'd narrow it down to probably these 2 regarding your situation. These are the pros, these are the cons. This is why it makes sense, this is why it doesn't make sense. So understand that concept. If somebody's going and let's say they're trying to grow their monies, and they're just trying to have that safe play on it, a portion of those dollars might make sense to go into a fixed index annuity. And I'm just talking about a fixed index annuity without an income rider, just a plain fixed index annuity. They don't want to see advisor fees. They don't want to see downward market losses. All those things I mentioned to you on reverse dollar cost averaging can be eliminated with a fixed index annuity. The downside is it's not going to give you as high a rate of return as an investment. So it's very, very important to be mindful of. So no mutual fund related fees, no advisor fees, no downward market losses. You could also play it with any time that the index receives a gain. You could use that gain to live off of for interest, for income that year. If it doesn't receive a gain, then you're not going to take out money from that account, or you could only take out up to 10% of your account value. There's a couple of different ways, or there are a couple of different provisions, and we make sure to calculate that like a perfect puzzle piece for you. So now comes the next type of annuity, which is known as the variable annuity. And this is something that I do not like. I do not like it. I think that there's a bunch of better annuity combinations than a single variable annuity, and there's reasons why. What I mean by that is I always hone in on reverse dollar cost averaging. I say, you know, obviously we want to look at the negatives, see what those negatives could do against an account value. If it's bad, don't go with it. If it's worth the risk, then maybe go with it. What a variable annuity does is they have very expensive fees, and they still have a very large risk. So with a variable annuity, just like that fixed index annuity, we understand with the FIA, it's going to gain when that market goes up, gain 0% when the market goes down, gain when the market goes up, gain 0% when the market goes down. What a variable annuity does is it ties the account to mutual funds, very expensive mutual funds. Financial advisors could still attach an advisor fee onto variable annuities to quote-unquote monitor that account for you. You also have insurance-related costs associated with variable annuities. So now what we're doing is we're supersizing the reverse dollar cost averaging effect on those types of accounts. So it's an insurance company that's trying to act like, or an insurance-related product that's trying to act like an investment, and all it's doing is making the individual fall victim to very high fees with not that much benefit, or not the benefits that you could get elsewhere. So if we think of that concept with a bucket, well, now we're not going to have a lid over it, and now we're going to poke a bunch of holes in the bottom of this bucket. So what that essentially tells us is what exactly are these holes? If you have dollars that are sitting in there and an individual goes and rolls their money into a variable annuity, whether that's a variable IRA annuity or a variable non-qualified annuity, what this says is this individual has negatives coming out, uphill battle struggle already from day one, or mutual fund related fees, insurance related fees, mortality and expense related fees, all these different sorts of fees. And the advisor that's selling you a variable annuity is going to hand you prospectus. The problem with the prospectus is it's going to be 300 pages long and it's going to be like watching paint dry on a wall. That's how boring it is. But understand that every single one of those fees could be as high as 55 different related fees associated with that account are all going to be outlined within that prospectus. So you have the mutual fund related fees, other fees, and then on top of it, some advisors charge an additional fee, an advisor fee, to monitor that account, which I completely disagree with for a lot of reasons. So in that example, let's say if it's tied to the market, and let's say the market, gained 20%, but you had fees, and your average fees are going to be on the low end about 3%, on the high end 7, 8, I've seen them as 9%. So let's just say if we're going on the low end at 3%, if let's say the market gains 20%, were you going to have a 17% gain into your account? Because you have to reduce what obviously what the negatives are. Let's say if the market loses 30% the next year, where you're going to have a minus 33% loss. So what it's doing is it's compounding what the negatives are, like reverse dollar cost averaging, against those accounts. That's the main reason why I don't like variable annuities. I've never really seen a justification of a variable annuity other than for the agent to make a very nice large commission with very little value to the client. The one really good thing that variable annuities did create, though, is something known as an income rider. What an income rider did was it took care of that problem that individuals had with annuitization, where it says that they're going to pay an insurance company a lump sum of money and therefore receive a set income stream for the rest of their life. With this attachment, with this additional rider attachment that's tied onto these variable annuity accounts, the variable annuity is, what's going on with that person's money is going up when the market goes up, going down when the market goes down, and then they're also attaching on a bunch of other fees associated with that plain variable annuity. When you add an income rider to it, what it's doing is adding an income account, an income calculation account that's stating that, okay, if this person wants to wait, a year or 3 years to trigger income, rather than that DIA that says if this person gives $100,000, they're going to receive $8,000 of lifetime income for the rest of that person's life, the individual surrendered all the money to the insurance company to receive $8,000. With the variable annuity, what it's saying is they're not annuitizing your money, or this income rider, what it's saying is they're not annuitizing your money, but you're triggering lifetime income through the income rider. So therefore, you still have control of this account value throughout your lifetime. So let's say if you go in that same situation, you trigger you gave $100,000, the calculation comes out to that they're going to pay you $8,000 per year to the day you pass away. And let's say you pulled out money, and let's just say that the market, was gaining 3%, but because of the fees, you didn't really have any sort of growth within that account. So you took out $8,000, and all of a sudden passed away. Rather than annuitization where nothing gets paid out to your beneficiaries, whatever's remaining in your variable annuity account value would be left over to your beneficiaries. So obviously that took care of the problem of annuitization. The downside to this is all it did was with this income rider, it added on enormous amount of fees that further compounded that reverse dollar cost averaging effect, liquidating this account value down to $0 as quick as possible so that the individual is just falling victim to that same annuitization type aspect. So if we understand reverse dollar cost averaging, and then we're utilizing variable annuities with income riders, what you now have is very expensive mutual fund related fees. You now have income rider fees. You now have all of those insurance related variable annuity fees. You might have an advisor that's attaching on an advisor fee. You have fee on fee on fee on fee. So now instead of that 3 to 7% in fees, you're now looking more along the lines of like 5 to 10% in a given year in fees, depending upon how much those fees are packed in there. The value that you're getting is, yes, you still have whatever's remaining in your account value to go to your beneficiaries, but this reverse dollar cost averaging, this compound interest going against the accounts, all it takes is one downward market loss and that account's almost liquidated. So it's going to liquidate your accounts very, very quickly with very little benefit of just saying, okay, I have an income, I basically have an income rider. Because let's say if your account value goes down to $0 and you're receiving $8,000, $8,000, $8,000, all of a sudden that person passes away, whatever's remaining in the account value goes to the beneficiaries. If you have nothing remaining in the account value, then nothing goes to the beneficiaries, and all this did was you set up a plan. It was a smoke and mirrors approach done by the agent, by the advisor that was selling you this type of product. He made his commission. He probably made, he or she made their additional advisor fee each year that there was money into that account. And at the end of the day, you have no more account value to pull from, and you're in that same problem that occurs with annuitization. It just maybe took a little bit longer to hit that problem, but that problem still existed, or still exists. So don't think that you're completely, SOL. You're completely shit out of luck with just saying, oh my gosh, I like that concept of an income rider, but what the heck is with this variable annuity? Because that income rider concept is what the fixed index annuity contracts basically stole. So with a fixed index annuity, we understand that you're not paying advisor fees, you're not paying mutual fund related fees. Majority of what those negatives, those downward market loss, you're protected at a 0% floor. All of those different aspects to eliminate reverse dollar cost averaging, but they also provide an income rider in conjunction with it. Meaning you have safety and consistency on one side on your physical money, on your account value side, with an income guarantee through that insurance company on the other, that you do not have to fall victim to that annuitization side. So whenever you hear like an FIA with income rider, this is what I deem in a lot of my marketing videos. I call it the hybrid annuity. And a lot of advisors call it the hybrid annuity. It's basically a hybrid. Technically, a variable annuity could be a hybrid, but I don't ever recommend variable annuities with income riders because mathematically, fixed index annuities with income riders pay the highest amounts of income, highest amounts of lifetime income in today's time. So, currently it's 2017. Anytime we compare a fixed index annuity with an income rider versus a variable annuity with an income rider, that income rider is going to be more powerful on a fixed index annuity side. On top of it, the fixed index annuity is going to give a more consistent rate of return than obviously what that variable annuity is doing, because the variable annuity has such high fees associated there. Now be mindful that hybrid annuities, fixed index annuities with income riders, their account values could still hit $0. When that does occur, well, now you're just that much further into the insurance company's pocket, and now you're leveraging their dollars, just like that break-even point on annuitization. We want to try to get into the insurance company's pockets as quick as possible. So this is why we compare. When we have hybrid annuities, once again, you have 1,200, 1,300 different combinations of those things. Over 95% of them are crap, are for the benefit of the insurance company, not for the actual individual. So all we're doing is we're cherry picking. We're saying, okay, company XYZ is better than company ABC. Company MRC is better than, PCA, whatever the name of the carrier is. Because we're an independent agency, we get to now cherry pick, and we have to be non-biased towards one carrier over the next, rather than you just walking into company XYZ and then them telling you their company is the greatest thing since sliced bread ever. We're able to represent all the carriers and work for the client, not work for the actual company. So we're representatives of the different companies out there, but we're not going to be biased towards one company over the next. It's whichever one mathematically is going to give you the highest amount of leverage into your as an income stream, if the hybrid annuity was obviously one of your main goals. So now I want to show you examples. I want to show you examples of when a fixed annuity could work, when a fixed index annuity could work, when a hybrid annuity could work, how to use them in tandem with an individual situation, and then when they don't work at all. So now let's go through a situation of a typical client that would call into my agency. And what I always try to tell individuals, as I said, that there's three main things that every individual needs to figure out before they're retired or currently retired on how to stay retired forever. It comes in three main components. What are your income sources? You want to have guaranteed income sources. You want to make sure that you have an emergency fund. And then you also want to make sure that you have a plan to combat inflation, inflationary protection. So if we have an individual, let's say that is age 60, and they currently have $500,000 sitting in their 401k account, and this person calls and they say, I want to retire at age 65. I want to make sure that I could retire successfully, not have worries, and make sure that my money is growing properly, but most importantly, suffice what my expenses are. My goal is to make sure that I have enough income coming to me in retirement so that I could travel, I could visit my grandkids, I could play golf, whatever that case might be. My current situation at age 65, when I want to call it quits, when I don't want to work anymore, I'm going to have Social Security income coming to me of $30,000. I have a small company pension coming to me of $10,000. I have that $500,000 in a 401k, and I have some money in cash as well. After going through my budgeting analysis, I understand that I need $50,000 of income for the rest of my life, starting at age 65. These are going to be my expenses, and therefore I want to make sure that I'm able to pull out $500,000 most efficiently, most effectively, and grow the monies that I don't have to touch. So with this situation, we understand what? This individual has a $50,000 need. They have guaranteed income sources of $30,000 and $10,000. So what this tells us is $40,000 are income sources or lifetime income streams. $50,000 is the goal. So therefore, we need to figure out a way to provide them $10,000 of lifetime income. We have $500,000 that they could go and leverage into possibly annuity contracts. So in this situation, we could figure out their solution in a really simplistic manner. We say they're currently age 60. Maybe this leg one, because they have 401k monies, they can go and roll over $100,000. When we go through our 1,300 different combinations of information, we might want to look at a hybrid annuity with a 5-year deferral, or the best annuity contract that pays about $10,000 with a 5-year deferral, triggering at age 65. So maybe company A says, yes, we could give you $10,000 of income. It's only going to cost you $100,000. Company B says, we give you $10,000 of income. It's going to cost you $130,000. Company C says, yes, we could give you that same $10,000 of income. It's going to cost you $115,000. So because company A is going to require the smallest deposit, it has the best cash flow percentage for a 5-year deferral for that individual age 60. Why would we go with company B or company C if we could save $15,000, $30,000 by placing it in the smallest possible annuity and only as much as necessary? So out of this $500,000 401k, IRA annuity number one with IRA annuity with the best contract is going to say $100,000. So this is leg one. In 5 years, we're triggering $10,000, and therefore the Social Security income, the pension income, and the annuity income is going to last them. The reason why I like using a hybrid annuity is because we are not annuitizing those monies. We're allowing that person to grow his money when the market goes up, not lose when the market goes down, trigger the income rider for the lifetime income, not annuitization when this person hits age 65. So that if he keeps living and living and living and all of a sudden passes away, rather than the beneficiaries receive nothing, the beneficiaries would at least receive his account value, and we're reducing that reverse dollar cost averaging effect. The next aspect is emergency funds. A rule of thumb is somebody wants to have between 6 to 12 months of emergency funds in their pockets, in their accounts at all times. So if we have $400,000 left over, because obviously 500 was initial, and then we used 100,000 into leg one IRA annuity, emergency funds, if his expenses per year is 50,000, well, maybe we want to leave $50,000 aside. This is not going to be beneficial to put into an annuity. Leg two should not go into an annuity contract. Emergency funds, we want to have something that's completely liquid. The good thing about annuities is you could receive that income, you could receive all those different benefits. The bad side is you have to play by the terms of the contract. You can't just go place your dollars into an annuity and then say, okay, I don't want this anymore after a year, and then try to remove all your monies. You might have restricted liquidity for those first couple of years, maybe the first 7 years, first 10 years. Well, they'll allow you to receive lifetime income, but any dollar that you try to pull above that, you could get penalized for that, because they have to balance their actuarial data and make sure that they're offering a favorable contract, and penalize those individuals that are not playing by the terms of the contract. So that's what I'm saying. If you ever go into an annuity, utilize it exactly as it's designed. Don't try to play games with it, because then you shouldn't be going into an annuity in the first place. Emergency funds, something liquid cash, well then $50,000 could go into an IRA money market account that is completely liquid. Tree comes, falls through their house, they have money to pay for it. Healthcare need comes about, they have money to pay for it. Different things that they could siphon from this money as just a rainy day fund sitting there. Portion number one is taken care of. Portion number two is taken care of. And now we have inflationary protection. So this could be used a couple of different ways. You could have it with a fixed index annuity and managed money, meaning investments. So you could say, okay, I have, in this case, $350,000 left over. Maybe take a portion of that, put that into a fixed index annuities where you don't have, so it's going to gain when the market goes up, not lose when the market goes down. There's no income riders attached to it. That's going to be more of your safe play. Maybe have $175,000, half of that, into that FIA play. And then the other side could go into the investments. That's going to be the stocks, bonds, mutual funds, ETFs, the commodities, real estate, all those different things. Now you could have fun with it and try to grow these accounts, because the only time you ever have to dip into this type of account, this type of $350,000 need, is if the inflation is increasing. The power of the purchasing power risk is being too great, and now instead of a $50,000 annual income need, it's going to transpire into a $52,000 income need. So maybe take a little bit more from those accounts each year, every couple of years that inflation is eating up, what those expenses are. So we're correlating that properly. Another way is to set up something known as an annuity laddering strategy, which is using a hybrid annuity with, if we understand that inflation is going to increase by about, between 2 to 4% in a given year, well, then we can mathematically calculate what your expenses are, which of those expenses are going to be increasing each year, to say, okay, at age 67, we want to trigger another $2,000 of lifetime income. At age 71, we want to trigger another $4,000 of lifetime income. So that you started off with $50,000 of income, then you increase to $52,000, then you increase to $56,000. So it's growing with you each and every year, so that you can leave as much money on the sidelines as possible that you don't have to worry about, that you can now utilize and invest as your fund monies. So the takeaway that I want you guys to realize is annuities are not the end-all be-all. They're not the best thing since sliced bread, but you can use them the right way for pure retirement peace of mind, or pure accumulation peace of mind. Just even something as small as just a safe accumulation, that you don't even have to use it for income. Well, then don't be looking at a hybrid annuity. This is the worst thing ever, is when I see individuals get set up in fixed index annuities with income riders, and they call over to my agency and they say, oh no, well, my account has a 7% guarantee. I say, no, it doesn't. They're not giving you a 7% guarantee on your money. It doesn't exist in today's age. What that 7% is just a calculation. It's just showing a calculation account on that income rider account, which is not your money. It is basically that calculation to determine how much lifetime income you're going to receive the longer that you defer that out. Sometimes income riders have a cost to it. Majority of the times they have a cost to it. So that would be the only negative if you are attaching the hybrid annuity. Some of them, they don't have any cost to it. So they could be built into the policy with 0% fees. So it really just depends upon your situation. It depends upon your age, how far out you are from retirement, different things to leverage annuity contracts. But as interest rate environment increases, well, you might see more favorability towards fixed annuities as opposed to hybrid annuities, or fixed index annuities could have higher cap rates as opposed to going with more traditional investments and more traditional investment strategies. So, the major takeaways is I really hope that you found value in this. Let me clear up the screen. And I wanted to really expose the pros and cons of these things and not say that these things are fantastic, but just show you the truth behind it. And that's what we try to do. I've been obviously doing this for a long time now, and people go with us because of our honesty. We try to educate first and foremost, and based upon your situation, if you're interested, you give us our call our 1-800 number. What I truly recommend is that you go to our website, retiresharp.com or fossilfinancial.com, and you book your appointment through our calendar. So whether you go to retiresharp.com or fossilfinancial.com, it's both going to take you to the same place, but you're going to see this little book your strategy session over here on the bottom right-hand side. Schedule an appointment, look at our schedule, look at our calendar, and then see whatever works for you, and we'll make sure, if you put in the notes section what you're interested in, we'll make sure that the correct specialist is giving you a call at that specific time. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. I believe it's because of this methodical process. So, if you have any worries in retirement, or if you're nearing up retirement, if you're 30s, 40s, 50s, 60s, whatever the case may be, reach out to us and see what your current situation is, because you don't want to just swing from the hip. You just don't want to shoot from the hip, and you want to make sure that you have a calculated, measured approach, and that's what we do. We have the best systems out there, and we try to have the best education out there to make sure that you're comfortable with every step of the way. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.